Every 6 to 8 weeks, the Forex market holds its breath. Spreads widen, positions get cut. Traders sit at their screens waiting for a single announcement that can move every major currency pair in minutes. That event is an FOMC meeting, and if you trade Forex, it is one of the most important things you need to understand. FOMC stands for the Federal Open Market Committee. It is the policy-making body of the U.S. Federal Reserve, which is America's central bank. 12 voting members sit on the committee, including the 7 members of the Fed's Board of Governors and a rotating group of regional bank presidents. The chair of the Federal Reserve leads the group and is one of the most closely watched figures in global finance. The committee meets 8 times a year on a fixed schedule. Each meeting runs 2 days. On the afternoon of the second day, the policy decision is announced, followed by a press conference from the chair. So what exactly does the FOMC decide? Its main tool is the federal funds rate, the target interest rate at which commercial banks lend money to each other overnight. By raising or lowering that rate, the Fed influences borrowing costs across the entire economy. When inflation is running hot, the FOMC may raise rates to cool things down. When the economy is slowing, it may cut rates to encourage spending, or it may hold rates steady and wait for more data. Each of those 3 outcomes, raise, cut, or hold, carries real consequences for the US dollar. Here is the part that trips up a lot of traders. Forex markets are forward-looking. By the time the meeting arrives, much of the expected move is already reflected in price. This is why you can sometimes see the dollar fall after a rate hike. If traders were expecting a larger hike and got a smaller one, that is a disappointment, and the market prices it accordingly. The question is never just what the Fed did, it is whether the Fed surprised anyone. The press conference adds another layer. A single word choice from the chair, describing the economy as resilient versus uncertain, can shift sentiment within seconds. FOMC days consistently produce some of the fastest and most volatile conditions on the Forex calendar. Experienced traders prepare well in advance. They study recent inflation data, jobs reports, and GDP figures to build a picture of what the Fed is likely to say. Many reduce position sizes before the announcement to manage exposure. Some wait for the initial spike to settle before looking for an entry. Trading involves real risk, and FOMC volatility can amplify that risk fast. Only ever trade what you can genuinely afford to lose. Before the next FOMC meeting, pull up a demo account and trade through the announcement with live prices. There is no faster way to understand just how quickly these markets can move.